Welcome back to another week of Mondial's Making Sense of the Markets, where we try and look through the noise in the markets in an effort to try and help you guys out. Now this week, Sean is with Ian Mortimer at Guinness Asset Management. Since graduating with a first class in physics, he then went on to complete a doctorate at Oxford University in experimental physics. Since 2006, he's been with Guinness as the fund manager on their Global Equity Fund, the Guinness Global Innovators Fund, and also the Guinness Euro Income Fund. So let's see what he has to say.
Welcome. This week we're going to go into a deep dive into one question, the world of dividends. Why? Because much of our client base is seeking income from their portfolio. In this current world of low interest rates, nothing can cash, very little on government debt, we need other sources of income. Question 1 for Ian Mortimer of Guinness Asset Management. Why so many dividend cuts so far this year?
So far this year, 2020 has been a particularly difficult period for dividend paying companies from a headline basis. So when I say headline, we're talking about all the dividend paying companies as a group. And we've seen pretty significant cuts throughout the last few months as the coronavirus has affected markets. We see really there's four main reasons why companies have been cutting their dividends. The first is just cash flow destruction. So clearly in the market we're in at the moment, when revenues of some businesses just stop overnight, if you like, that's going to make it very difficult for them to continue to pay out dividends, because they're going to need to keep that cash back just to keep their day-to-day businesses going. The second element is prudence. So companies seeing that the market is quite difficult, there's lots going on, and therefore they might be holding back a little bit to see how the year progresses. The third is really regulatory pressure. The main thing here is in the banking sector in particular, where regulators have told certain industries you should not pay a dividend, and therefore they have to follow that guidance. And then the fourth is government pressure. So we've seen various governments around the world, and particularly in Europe, asking companies to maybe hold back on paying their dividends to try and use that ability to keep that cash, to whether it's to maintain employment or protect those companies from getting into insolvency problems. So if you put those four things together, they're really why a big reason why we've seen so many dividend cuts at the headline basis.
Question 2. Which sectors and which regions have been most affected by dividend cuts so far this year?
So if we take those four examples, cash flow destruction, prudence, regulatory pressure, and government pressure, and we think about how those four elements have actually affected different sectors and different regions, we can start to understand why we've seen the biggest cuts from a dividend perspective in certain places. Firstly, if you take cash flow destruction, clearly there's some companies I mentioned where this sudden stop, if you like, in terms of their sales and revenues will have a direct effect. And so there you're thinking about companies in things like the airline industry, hotel groups, restaurant chains, house builders, for example, some companies in the energy space and material space. So clearly that's been significant pressure on their revenues, and therefore they have been most affected. If you think about the second element that's probably had the biggest effect, it'd be a regulatory. And that was really, as I mentioned earlier, certain regulators telling certain industries that they should not pay a dividend. In particular, that is the banking industry and the insurance groups. If you take those together then, and you think, the third example would then be government pressure. And we've seen an example, for example, in France, where actually the government there has asked companies to stand in solidarity with the French state and cut dividends by 30%. Not all companies have followed that, but quite a few have. And therefore, if you look at where the dividend cuts have been most severe, it would be, as I say, from a sector perspective, companies like the airlines, the commodities groups, some of the house builders, as I say, where they just haven't had an ability to have any cash to actually pay those shares back. And then more specifically, from a regulatory perspective, in areas such as the banking industry. If you then take those two sectors and you think about what regions of the world have most exposure to those particular sectors, it would be places like Europe specifically. So what we've seen is that if you look at the Europe index, you've seen significant dividend cuts at the Europe index level because they have the highest weightings to areas such as commodities and the banking sector. If you look at something like the US, they have a lower exposure to those areas, and therefore the cuts in the US have maybe been not quite as severe. And then lastly, you'd have Asia, and Asia actually has been relatively well protected because they tend to pay on a payout ratio type basis, and therefore have a little bit more flexibility. So what we've seen from a regional perspective is dividend cuts around 30 to 40, maybe even 50% in Europe and the UK. You've seen dividend cuts around 20 to 25% in, say, the US. And in Asia, that looks more modest, and maybe it's somewhere between 10 and 20%.
Question 3. Where are dividends most likely to be maintained?
So we turn on its head, and we've talked about a lot of negative sectors and regions from the dividend cut perspective. If we then think about actually where are companies actually doing quite well, which companies are more likely to be able to continue to pay their dividend, because it's not all doom and gloom. And if we think about the types of companies that are going to be more likely to be able to pay their dividend, it's going to be those companies that are doing well during this period. Things like the consumer staple businesses, the Nestle's and the Procter & Gamble's of this world, where their revenues have not been severely affected. And in fact, if anything, some of those revenues have increased. It's companies that have very strong balance sheets. So if you have a strong balance sheet, that means even if you are getting into some trouble about from what's going on currently in the world, you're not under severe financial pressure because you've got quite a big buffer. Maybe you can borrow more money, or maybe you've got a lot of cash on hand, which allows you to continue to pay that dividend. We also see companies where there's a strong family ownership from a shareholder perspective, continuing to pay their dividend. Often if you've got a company that has a big family stake, that family will be very interested to continue to get their dividend because they may rely on it. We've seen companies such as VF in America. They make things like Vans trainers and North Face jackets. They've got a big 10% stake from their original founder or backer, and they've continued to pay their dividend throughout this period, despite the fact that sales of their shoes and outdoor wear have really been quite significantly affected. And the last thing I might say is companies that have a very long history of paying a dividend. So if you have a 25-year history of continuing to pay and grow your dividend, you're probably not going to want to cut that in this period if you can at all help it. And we see companies such as Raytheon, which is a US defence and industrial company, has continued to pay and actually grow their dividend throughout this period, for example.
Question 4. From July 2020, what is the outlook for dividend stocks moving forward?
So clearly as a group, we've got to be quite careful when we think about the overall outlook for dividend paying companies, because I think what I've been trying to say in the last few questions is that yes, we've seen big cuts and some companies, Royal Dutch Shell for example, cut their dividend 65%, their share prices been under pressure. Similarly, the airlines for example have done very poorly, maybe they've rebounded a little bit more recently. But as I mentioned earlier, not all dividend paying companies are created equally. And what we see is that if you can focus on the dividend paying companies that are actually quite strong, whether that's through their demand is robust, whether they have the strong balance sheet, maybe they've got a good founder shareholder, or maybe they've got that long history of paying a dividend, then actually those types of companies, we think, could actually continue to do quite well from now on. Why would they continue to do well? In this environment, any company that can show growth is going to be rewarded. It's a difficult market. If you're showing even reasonable growth, you should be rewarded for that. And we think plenty of those companies where we mentioned where demand is remaining robust will be those. And we also know on the other side that income is going to be pretty difficult to get hold of. There's going to be less places for investors to look. bond yields are very low, for example, and therefore the yield on equities is going to look favourable in relation to that. So if you can put those two things together, strong companies that continue to do well, that have strong balance sheets and cash flows that are being maintained through this difficult environment, if you can combine that then with that income that you can receive from those companies, we think actually that's a very positive combination, and actually a lot of investors are going to be looking for that over the next few periods, whether that's over the next 6 months, 12 months or even 2 years, and therefore though we think there's a good tailwind behind these types of companies, and actually a very sensible and interesting place to consider investing in today's current market environment.
Graph 1. Ian, please talk us through this slide which shows decade periods of time returns on the S&P 500 in terms of capital appreciation and dividends.
So this slide pretty simply just shows you the total return of the S&P 500, the US index, going in individual decades, going way back to say the 40s. And I think what this is really trying to show you is two things. The first is if you look on average at the numbers near the bottom, showing you the average of each of the different periods we're looking at, you see that dividends make up a really decent proportion of your total return. And in fact, I think it's just under 50% on average. So dividends, wherever you are always being very important in terms of the total return you'll receive from an equity investment. However, what this is also showing you is in periods that where there was slower growth, things like the 1970s, for example, the proportion of your total return that's going to come from dividends is much, much higher in those low growth decades. And the reason that is because dividends tend to be a lot less volatile than earnings. And in fact, if you can pick the right companies and they can continue to pay their dividend through a difficult period, then that income you're receiving is going to be much more relevant and important over that period. This may be a period we're in at the moment. It's going to be very difficult, despite all of the stimulus packages, whether they're fiscal or monetary, that we've seen. We could be in for a period where growth is harder to come by and somewhat more modest. Therefore, it could be an interesting time to consider your dividend-paying equities as a way to capture some of that proportion of your total return from that income you're going to receive.
Graph 2 represents a comparison between a 10-year inflation in the US CPI against the S&P dividend return per share.
So inflation is something we all have to consider. The outlook for inflation has been pretty modest. In fact, inflation expectations have actually been going down over the recent period. However, that's not to say that could reverse, particularly in a period where we are seeing these sort of significant stimulus packages being implemented, firstly through the monetary side of things, but then also from a fiscal stimulus. Lots of chat about big infrastructure spend, whether it's in the States or Europe or elsewhere, to try and sort of grow economies out of the current malaise. Now, what's interesting from a dividend perspective is the fact that your income stream from a dividend-paying equity can actually be really positive in an inflationary environment. And that's because over long periods, as this chart is showing you, is that the dividend growth actually matches or correlates quite closely with inflation if you take a longer term view. And the reason that's the case is that if you have a bond, if you like, and you're getting a single coupon, that coupon doesn't grow. You know what it is, but it's not going to grow. So if you have inflation, that coupon you're receiving in real terms is getting smaller and smaller in terms of what you could buy with it. However, with a dividend, what you're receiving is actually a coupon, if you like, that can grow over time, because if the company underlying that dividend payment is growing itself, then they can increase those cash flows gradually over time. What that means is that you can protect yourself, if you like, if you're receiving that income, and maybe you want to live off that income, for example, as many people do, that actually that income can grow over time, and that's a very good hedge, if you like, against a potential inflationary environment going forward.